Inflation just hit another 40-year high. But we don't need a fucking report to tell us that because we all feel it every single day in our wallets. So naturally, this has many investors wondering, what are the best investments during inflation? Well, I went ahead and pulled up some cool charts and data that I want to share with you guys on that specific topic. Of course, along the way, I'll be sure to drop in my own 2 cents, anecdotes, and data-driven insight. So here we go. First, let's start off by talking about gold, because you really can't have a conversation or discussion about investing during inflation without hearing about gold, right? It just seems like gold is this unanimously agreed upon inflation hedge. If you want to beat inflation, just invest in gold. Well, I think we're going to see that is not always the case. So let's go to the first chart that I pulled up right here, which shows the total returns for commodities, REITs, and gold during inflationary periods. So we can see the inflationary periods here, 73 to 79, 80 to 84, and then 88 to 91. In the total return on an annual basis, we can see down here at the bottom, it says asset class returns are total annualized returns. We can see the returns on an annualized basis during each one of these periods. So from 73 to 79, gold was the place to be. It had an annual return of over 30%. I'd, guesstimate this to be 34 or 35% annual, whereas inflation was only about 8 or 9%. So we would say that gold had a 30 or 35% nominal return, minus 8 or 9%. We'll call that, 34 minus 9, 26? Am I even doing that right? No, that'd be 25. We'll just say it had a 25% real return. So the nominal return minus the inflation rate gets you your real return. And then we can see from 80 to 84, gold actually had negative returns. Meanwhile, inflation was going up at about 6 or 7%. And then 88 to 91, gold was again negative, while inflation was still pretty high. So what I want to point out here is that gold is not always a reliable inflation hedge. It performs differently during various economic climates or during various time periods, right? I don't know the specifics of the economic climate and other scenarios that were going on during these time periods here, but we can see that clearly when things are inflating, it does not always mean that gold is going up. Now, interestingly, we've also got REITs and commodities on here. REITs being real estate investment trusts, that would be what the acronym stands for. But in all practice, it is not specifically real estate investment trusts. There will be companies in here that have high exposure to real estate, like a company might be a public storage company. I think public storage is even the name of a company, right? They are basically a real estate driven business. They get lumped into REITs as well. So anyways, REITs and commodities did pretty well, all of them being positive during these time periods of inflation that we were looking at here. So I think that's pretty interesting. REITs and commodities being quite resilient, in this case more resilient than gold over this limited time period we were looking at here. Next up, we have this cool little data set from BlackRock, which shows the valuation or the annual returns of various asset classes. In this case, we've got US real estate, global infrastructure, stocks, government bonds, and IG bonds. I don't know what that is off the top of my head. I'm trying to think, what are IG bonds? Let me just see if we can find it in the document here. Nope, it doesn't say. Maybe it's intermediate term government bonds? I'm not really sure, but for the purpose of this discussion, we're really not going to be looking at them, and basically they perform about the same as government bonds. If you know what IG bonds are, educate me, let me know in the comments below. Anyways, we can see how they performed during various periods of inflation, and they looked at data going back to 2001. And they've got the growth environment and then the inflationary environment, right? So high growth environment, high inflation. Down here, low growth, low inflation. And in the details, they define what high growth and high inflation is. So high growth periods are when US GDP is greater than 2.5%. And I would say that is on an annual basis. They probably look at it quarterly. And high inflation periods are when US CPI is greater than 2.5%. Okay, so during periods of high growth and high inflation, US real estate does well, global real estate does well, and global infrastructure does well, outperforming stocks and the two asset classes of bonds that they have here. During low growth and high inflation, we can see that infrastructure does well, whereas, real estate does kind of well, but stocks do poorly and so do bonds. So I think the big thing here to take away is that clearly that's what their headline is. Real assets have historically outperformed in inflationary environments. And what they're really meaning by this here is real asset stocks, right? Stocks, companies that have high exposure to real assets. And that's going to be your real estate and infrastructure type of companies. They outperform the broad market of stocks. They really outperform bonds. Interestingly, down here in low growth, low inflation, that's when those real asset companies don't do so well. And, bonds do quite well during that period. And then, naturally, I'm seeing stocks are kind of like always low. I'm a big stock guy. I'm like, when do stocks do well, right? Well, stocks do well during a period of high growth and low inflation, which, you got to think about it. That's really what we saw from 2010 or 11-ish until COVID came around in 2020. We had that 10-year period where stocks were just rip-roaring up, and we were in a high-growth period with low inflation right there. So we can see some asset classes, REITs and commodities. REITs obviously being a real asset equity type of investment. They do well during inflationary periods, right? And then finally, we have this data right here, which shows U.S. equity sector performance during inflationary periods. So I think one thing a lot of people don't consider is that there is how do I say this? There is less correlation. There we go. There is less correlation among sectors of the S&P 500 than there are among asset classes of U.S. equity. So basically what I'm saying here is that there is less correlation, or we could also express this as more diversification. That's, I think, what I was going for in my mind when I initially started to talk about this. So there is less correlation between, say, tech stocks, the tech sector of the S&P 500, and the utilities or energy sector of the S&P 500 than there is between large growth and small value, right? So large growth and small value are typically going to be the least correlated asset classes of U.S. equities, whereas there's going to be even less correlation among tech stocks and then energies or utility stocks. So we can see the sectors right here. The U.S. equity sector performance in high and rising inflation environments from 1973 to 2021. And we can see the historically high level of outperformance versus inflation. So this would be real return essentially. And then the historical high probability of beating inflation over a 12-month period, right? So percent of time with positive real return. So there we're coming back to that terminology of real and nominal again. Real is the return above inflation. So from this period, right, from the period that the data was looked at, what is the probability that they have a positive real return over the next 12 months? We can see energy and equity are reliably having a high real return in these inflationary periods, and generally by quite a bit. So this is pretty cool. And I said energy and equity, I meant equity REITs, right? Energy and REITs. So basically we can kind of take away from this in this data that we've looked at here that REITs in commodities do pretty well. Gold may or may not do well. Again, from this, real estate does pretty well, and infrastructure type of equities. And then finally here, REITs again, we're kind of confirmed that REITs do pretty well during inflation. And then energy. And energy would fall into what I would consider an infrastructure equity. Right? I would consider, when it says global infrastructure, I'd really look to energy and utilities. Right? So on this basis, what I'm kind of hearing here is REITs, commodities, gold, and then energy. And I shouldn't say and then energy, but the four of them, all of them have pretty substantial value and make good investments during inflationary periods. Now, let's go back and touch on gold, right? Because gold is this weird thing, and I think that the masses are wrong. Clearly, the masses are wrong on it when people say gold is the best inflation hedge or gold is a great inflation hedge. Let's just kind of go back and touch on this. And I guess while we're looking at this, we'll also talk about what is the best hedge against inflation long term, right? Because these asset classes do good during inflation. So let's pull up this chart right here. It's not a chart yet, but we're going to put on here, we're going to put US stock market, and we're just going to put 100% of our allocation into that. And then we'll also compare that to a gold allocation. So we can put gold on here at 100%. So this basically just shows an investment in the US stock market versus an investment in gold. And we'll go back in time. All right, and this goes back to 1972. Okay, and now we can see the performance, of the two of them. All right, so $10,000 invested on a total return basis in the US stock market, and a total return basis means that all of the dividends, distributions, and capital gains were reinvested back into that same investment. So if US stock market, our investment in that paid a dividend, which it does, that gets reinvested. Any gains that are distributed, they get reinvested. That would have grown into, over this period of 1972 through today, or the most full month that we have data for, which is February 2022, $10,000 invested in that would have grown to $1,635,000 at an annual growth rate of 10.69%. Compared to gold, an investment in that $10,000 would have grown to $407,000 at an annual growth rate of 7.67%. So there's a huge difference, right? The final balance here in the US stock market is 4 times that of gold, literally about 4 times that. The compound annual growth rate is only a 3% difference, though. I think this is something that is very important because a lot of people look at this and they say, oh, there's only a 3% difference in annual growth rate. Or they'll look at annual growth rates and say, oh, there's only a 3% difference. But 3% compounded over this time period, which is, 30, 40, 50 years, 30% or 3% compounded over 50 years is a fucking huge difference. But let's just look at these two here, right? So we can see during the 70s and then kind of into the early 80s, basically the 70s, through the 70s, gold just rip-roared up. Literally just rip-roared up, outperforming stocks. But then since then, it really hasn't done much. During the great financial crisis, the value, on a total return basis came out to be, got close to that of the US stock market. But then since then, the stock market rebounded. So basically what I want to point out here is that the long-term value of gold as an inflation hedge is really not there. The best performing asset class out there, if you want to hedge against inflation long term, is equities. Equities, going back further than 1972, have consistently generated an excess return beyond inflation. They have the highest real returns of basically any asset class out there. So if you want to beat inflation long term, stocks are where to be. In the short term, though, that does kind of change. Things do kind of change, and there are specific asset classes that do perform well during inflation, as we've seen: gold, commodities, real estate, and energy. They perform incredibly well during inflation, but not necessarily outside of inflation. So on that note, what could we strategize here, right? What could we strategize? And I would say at a simple level, a simple strategy would be during inflation. And if you're following the inflation data and inflation is higher than average, and in this case, I think they looked at 2.5% as the kind of standard. Did this specify? This data did not specify what they were using to consider an inflationary period. And this one said 3%. So, you would be pretty fair, I think, to make a strategy where if inflation is above, say, 2.5%, then you go into an equal weighted basket of real estate, commodities, gold, and energy. And I just put them on a chart here which shows their performance during the last 6 months, the last half of 2021. And it shows all their performance. And the S&P 500 is on here. So red line is energy, gold is like this turquoise line, green is commodities, and then purple being real estate. So for that last 6 months of 2021, nothing too crazy was happening between them all. But then if we go year to date, which right now it's March 22nd, I think. Yeah, year to date, we can see, that there's clearly some difference. And it was kind of in the end of 2021 that things started getting published that, hey, inflation was getting out of control. I didn't really follow the data. I don't know when things really got above 2.5% on inflation. But we can see since then, energy doing well. And then second to that is commodities. And then gold. And then finally, real estate has actually gone down. Real estate's actually gone down more than the S&P 500. I am very surprised by that. The S&P 500 is no doubt benefiting from the sector of energy performing well. But if we were to equal weight these, right? What if, you looked in when we got the reports, or you thought when we got the reports, hey, inflation is high, inflation is more than 2.5%. I want to go into this basket and equal weight them. Well, how would that have done? We can add that up. We can go, I'm just going to round the numbers here for quickness. 38.5 plus 6.22 plus 27.93 minus 8.75, right? Divide that by 4. So if you had equal weighted all of these, at the start of the year, you'd be up 15.975% without having to guess which asset class is really going to do the best, which one is going to outperform. Because it's really hard to predict. There are maybe some quantitative models out there, some momentum and trend types of things you could use to predict these, or not predict, but to try and predict, hopefully with some level of accuracy, which asset classes are going to perform well during the current economic climates. But by and large, I think you would probably be best served just simply equal weighting into these asset classes that we know to do well during inflation. So guys, that's a wrap on this one. I think I've covered about all I can. Energy, gold, real estate, and commodities, those are typically your best investments during inflation, and my personal strategy would just be to equal weight them during an inflationary period. What do you guys think about this? How's your portfolio performing as we go into this headwind of inflation? Let me know in the comments below. I'm signing off on this one.